Let's continue the conversation, extend things with Crossmark's Victoria Fernandez, Jim Bianco of Bianco Research. Hey, Victoria, good to catch up with you. Walk me through it. Your take on the jobs report 40 minutes ago.
Yeah, well, Jonathan, I mean, I think when we look at it, the market is pleased with the number. It wasn't too hot of a number. I mean, there was the expectation that we could get a lot more. Look at St. Louis Fed. They were saying maybe north of 500 on the number. So I think the market is relaxing a little bit. We had a quick knee-jerk reaction higher. We've seen that come back. We've seen yields move a little bit. I think this tells us that they really don't have an answer to the September meeting. Maybe people thought they would get it here, but I don't think we do. So they're continuing to see 50, maybe 75 basis points at the meeting. I think the most important component, Jonathan, of this is the participation rate. And Mike was talking about it earlier. You know, the Fed wants to see the labor market weaken, but we don't have to do it by destroying jobs. We can do it by bringing more people into the labor force. And I think this was a good start to seeing that happen. I think we need to watch that. That will control wages. That's going to be a big component of that sticky inflation. So we need to continue the trend with that.
Jim, what do you think?
Yeah, I'd agree with most of what Victoria said. And what I'd add is, you know, last week we got an 8-minute speech, and Chairman Powell was very emphatic at Jackson Hole that they were going to fight inflation. This number shouldn't really change that. It's not going to change it either way. And that's why the market is now pricing still better than a 50% chance the Fed is going to move 75 basis points. So I think when you put it all in the mix and you stir it up, I think what you come out with is, unless the CPI data or the stock market has a giant move in the next 2 weeks, or either way, it more and more looks like we're going to get a 75 basis point hike on September 21st.
And Jim, that's the struggle at the moment for a lot of people in this market, that even if you take the constructive view from this one data point and extend it out, Rick Reeder of BlackRock was on moments ago and he talked up a soft landing. He believes in a soft landing, but he still doesn't think we've seen the end of it in this market, Jim. So apply what you think about the economy to what you think about the market. How difficult is that to reconcile the two at the moment?
It's very difficult. And I think the reason is because we all are focused on the economy and we want to know whether or not there's going to be a soft landing or not. But the Fed is focused on inflation. The economy could just sit there and it can do what it wants. Look, we had 2 negative GDP reports in the first half of this year. Didn't stop them from raising rates 200 basis points. So I think really what we've got to do is we've got to pivot away from the economy, focus on the inflation story. And the Fed is committed to raising rates till we get to 2%. Yeah. That's not happening for a long time. So I think when you do it when you look at it in those framework, it makes sense that they would hike 75 and they would stay very aggressive. And I think that's what the market's trying to sort out right now.
And they want to keep financial conditions tight. So, Victoria, with that in mind, even if you can take a constructive view on this jobs report we've had, and maybe even on the future, and there are some optimists out there, I struggle to find them, but they exist. If you see
framework, it makes sense that they would hike 75 and they would stay very aggressive. And I think that's what the market's trying to sort out right now.
And they want to keep financial conditions tight. So, Victoria, with that in mind, even if you can take a constructive view on this jobs report we've had, and maybe even on the future, and there are some optimists out there, I struggle to find them, but they exist. If you see pops like this one, have we gone from buy the dips to sell the rips? Is that the play now?
Well, I'm not sure that that's the play at this point. I mean, we've got the inflation numbers coming out in a couple weeks, and to me, that's going to be key, probably more important than the jobs report that we have now. The Fed is going to be watching that. And look, you've got an economy that has some strength. If you take everything else out about what the Fed is doing, and you look at an ISM where you've got new orders and employment moving higher, you have supply side constraints diminishing, you've got an unemployment rate at 3.7%, nothing there tells us that we're in a deep economic concern or recession is imminent. So I think you need to balance your portfolio with that. Find those names, those quality names that have good earnings, add them to your portfolio on down days. I don't think there's anything wrong with that, but you can still take a little bit of a defensive position with some healthcare names or with some staple names like we're doing. But I think you still need to be in the market because the economy is still strong.
Victoria, Jim, sticking with us. Let's see if this moves.
We've been worried that the market was too optimistic and that the reality was going to set in. That's exactly what we're seeing.
We are seeing a meaningful sell-off in global bonds.
This is about global interest rates.
Fundamental repricing.
Repricing higher, I think, to the global central bank community that's willing here to risk a recession just to fight inflation.
Return from artificially low rates to a more normal bond market environment.
I do think the longer duration bonds have further to fall.
I still think that we have seen the yield peaks for the cycle.
Momentum is probably going to continue to push yields higher.
It's certainly going to be an interesting next 2 or 3 weeks in the run-up to the Fed.
It's been fascinating. We've said that more than once. Global bonds now falling into a bear market, falling more than 20% from their 21 highs, with central banks doubling down on their commitment to tame inflation. Taylor Riggs with us for more. Hey, Taylor.
John, you know the math. Bond price down, yields higher. That has been the name of the game, and we finally get it when you take a look at sort of the global bond market. That terminal chart there about really falling now about 20% from the latest peak, as you can see. I wanted to focus on the U.S. as well, because it has been sort of a huge movement on the front end of the yield curve. In the last month, 2-year yields are up 43 basis points to starting to get closer to that 350 level, the highest since 2007, as we've talked about. And then further out on the yield curve, I'll point you down to the bottom of the screen on a 30-year yield that still manages to rise 37 basis points. So this feeling of more hikes on the front end, slowing growth on the long end isn't actually playing out. We're really seeing almost a parallel yield curve shift all across the curve. When you dive down underneath sort of the surface, you're getting sort of a regional composition here, if you will. North America, of course, as we've talked about, you're off about 12% or so. You get a lot of LatAm. Europe as well is sort of the big decliners. Eastern Europe, when we think about sort of the big yield moves higher and some of the big prices lower, overall that gets you to sort of those almost double-digit declines that we've seen.
Taylor Riggs, thank you. Looking at the bond move right now, yields backing away. We're now down 7 or 8 basis points at the front end, 342 on a 2-year. Looking at the equity market, a lift again, up almost 1% on the S&P 500. Mohammed Al-Arian weighing in on Twitter and saying the following: something for everyone in the jobs report today. He goes on to say the economic outlook benefits from continued solid job creation and higher labour force participation. The Fed will welcome muted wage growth and the uptick in unemployment. Markets will see this as warranting diminished hard landing concerns. Connor Senna, Bloomberg Opinion, also out on Twitter right now. He says the following: we're a soft CPI report away from markets saying Jackson Hole and Kashkari on Odd Lots, the podcast hosted by Tracy Alloway and Joe Weisenthal here at Bloomberg, was peak hawkishness. I want to get to Jim Bianco on that. Jim, we made the mistake earlier this summer saying peak hawkishness, Fed pivot. Are we at risk of making the same mistake again?
Yes, we are, unfortunately. I know a lot of people are having a hard time understanding what I said earlier. Fed is looking at inflation, the economy. And as long as the inflation numbers stay high, and high is defined as anything over 4%, they're just going to keep going. And they couldn't be possibly more clear. And you're right, Neil Kashkari saying he was happy to see the stock market sell off as hard as it did. They're not going to crumble on one week CPI report in 2 weeks. If they did, they blow all their credibility. So I know that this has been the story of this year, is the Fed talks hawkish, we say they don't really mean it, and then we're surprised when they do mean it. And unfortunately, that song continues.
Victoria, why do you think we're struggling so hard, so much, to internalize that message that Jim just conveyed?
Yeah, well, I think there's been a lot of credibility issues around the Fed for the whole year. And so now that they come out and they say, no, really, this time we're telling you the truth. This is what we're going to do. We're going to keep our foot on the gas. We're going to continue to raise rates. We're going to get to that terminal rate of 3.75, 4%. Mestre, I think, even wants to go higher than 4%. I think it's hard for the market to believe that when they're seeing things like commodity prices come down, when they're seeing supply side constraints start to ease. So it's hard for them to put the two together along with a stronger economy. But I'm with Jim. I mean, look, when we were having client calls at the end of the last quarter, we kept saying, don't believe the story of the pivot. They're not going to pivot. They are going to continue to raise rates. And so we think people need to adjust to that story and believe that they're going to do that. Can they do that elusive soft landing? I think they can, because of the strength of the economy, because of the labor market, because of the consumer balance sheets. We have the ability to do that. But I think we need to believe the Fed, and people are having a hard hard time doing that right now.
A super difficult time, and it raises questions about the sustainability, the durability of the bounce on my screen right now. Victoria Fernandez, Jim Bianco will stick with us through the opening bell. We come down to Victoria and Jim back with us for a final thought. Jim, you and I have gone back and forth over the last few months, and you know the theme I want to pick up on, the new consensus. Last year it was transitory. This year, you've heard it a million times, we all have. It's short and shallow. We'll get a recession, but short and shallow. Are you pushing back against that?
Yeah, I think so. I'm going to agree with Michael that the history shows that the Fed, a soft landing is what we call it before it becomes a harder landing. For the Fed to bring this plane in a soft landing would be extraordinary, especially given the volatility that we've seen in inflation. All the signs would point towards something to be a little bit more difficult than we're all hoping. Today's employment report was a good step towards a soft landing, but it's only just one report.
Victoria, your take on the same thing?
Yeah, I don't think we're going to see a recession this year. I think we get a soft landing. But when we look into next year, look, we are not in a bubble in this global economy. We've got less than a third of global PMIs in expansion territory. So I think at some point that is going to feed through along with higher rates and hit our economy. We're looking more towards the middle of next year for the pain to really hit.
That's the tough point, and I'm pleased you brought it up. It's got to be Europe. It's got to be China for that matter as well, Victoria. Saw another city shut down yesterday in Chengdu. It was Chengdu of about, what was it, 21 million residents, Victoria, in China. The difficulties out there in the global economy, when do you expect to see that show up in the earnings of some of these big multinationals? And I'll go a step further. Given the tightening of financial conditions here in the United States, we need to think about the tightening of global financial conditions. With the inflation backdrop in Europe, that's not at a peak. A lot of people think that's still in their future, not in their past. What does all that mean for how things look here in America? What's the spillover effect look like?
Yeah, I think you're looking into next year, and you've got to think when you look at the energy concerns that are in Europe. I mean, Europe is about 24% of our exports. They're not going to be able to have high demand there. And you look at China and they're exporting. They're not going to be able to do that either with a lot of their factory shutdowns that they're seeing. So as global demand declines over the next 9 to 12 months, obviously that's going to have to flow through to us. And that's where we see more of the concern. Not this year. We will have a small growth recession. That's okay. The economy's strong enough to handle it. But you let higher rates feed through for another 9 months. You let the rest of the economy do that. You see spreads start to widen on corporate credit here because of earnings and then overseas. That's where you're going to have the pain come in. And I think you're looking middle of next year for that.
Victoria, great to catch up. Thanks for being with us. Victoria Fernandez here with us in New York. To Jim Bianco, thank you to you as well, sir. After the jobs report from about an hour and 10 minutes ago, looking ahead to the long weekend. Enjoy the long weekend. Coming up.